We'll try to keep this short and sweet. We have a half an hour allotted time. We'll try to have the webinar completed in less than that time, leaving the questions and kind of comments for the end, so that we can get to the question and answering, and we'll be reviewing the comments throughout. First and foremost, thanks so much for showing up. Please be patient with me. I am losing my voice, so I do have water. I'm taking sips periodically. We'll get right into it. It's first-time home buyer guide. Now, this is meant for individuals that qualify as first-time home buyers, which you'll learn later in the webinar is 3 years. If you not own a property within 3 years, you're a first-time home buyer again. If you never own a property, you are obviously a first-time home buyer. If you own a home, you're going to pay attention to certain things that maybe you're re-entering the marketplace. You want to kind of explore new options this time as being a new first-time home buyer again, utilizing some of our really game-changing DPA programs that we'll talk about a little later in the presentation. Okay, let's get right in it. Okay, a little bit about us. Citizens Financial is proud to be your real estate and financial brokerage. The office is located in Northern and Southern California. We're excited to highlight our partnerships with the Bell Group, serving the Los Angeles region, and the Hinton Group. The Hinton Group is based here in Northern California, serving the whole Bay Area and the Sacramento Valley. Citizens Financial and our partners have curated an exceptional portfolio of mortgage products to serve the complete spectrum of California homeowners. That's something we're very proud of. What we provide, the products we have, and how we're able to have a very diverse portfolio of jumbo products, non-premium products for investors and for first-time home buyers. Next, we go to the homeownership tips. Please, these are simple. Start saving early. It's very expensive. Even though we have DPA programs, do not count on them. These programs come and go. They don't come and go like the wind, but they might stay for a couple of years, change. So you want to start saving early, get in the mindset of homeownership. Pick your comfort housing payment. The biggest issue I see, it's my second presentation of the day, I really try to give advice. Do not let someone dictate to you what you can afford. You need to come to the transaction knowing what your comfortable payment is. Please, it's the most important thing. Find out what you can pay, what your housing payment that you want to have, then find the house and the plan that matches it. Explore your loan options. If you're a veteran, you have earned the awesome abilities of VA benefits. You have that, you have conventional, you have FHA, VA, USDA, you have DPA programs based on FHA and conventional. Pick your options. Get pre-approved before you shop. One of the worst mistakes you can do is get emotionally tied to a property. You run around online or in person, and then you find out how to buy that house, how to get pre-approved. Bad mistake. Get pre-approved first, find out your price points, then find the house that matches it. Request a referral for a local realtor. Very important. Real estate is local. You want to make sure you align yourself with a local agent that's very tied in. They might have insight on properties coming to market, pocket listings. They have relationships with a lot of times the seller's agents. Therefore, they can get your offer kind of have a higher priority and preference if they have a relationship with the other side, knowing that when that deal comes across their table, that realtor is representing you, and that little extra can help you get that winning offer in a competitive market. And once for all, happy house hunting. Like, take all these tools, and we'll get into it right now and kind of talk about how it's all coming together so you can have that pre-approval letter and feel armed to go shopping for the next house for your family. So here's a little purchase timeline. Now, there is a lot of stuff to do before step one, but for the sake of a timeline, I wanted to get to the point where hypothetically you have reached out, you went online, maybe you filled a loan application out online, you provide information to say Citizens Financial, the Hinton Group, or the Bell Group. You've talked to a loan officer. You have now gotten a pre-approval. You're shopping with your realtor. All of a sudden, you got an accepted offer. Now let's start the timeline. Submit the complete loan with the bank to underwriting. Very important. You have a pre-approval. You have a pre-approval letter. You have an accepted offer. You put money in escrow, earnest money deposit, and we go to submit the whole transaction to our investor. Please make sure it's a whole transaction. We don't want to have missing documents and trailing documents, because then therefore it will delay the process of your approval. Step 2 is property inspection. Once we get the initial loan sent to the underwriter, you will get a set of disclosures. You'll review and sign the disclosure electronically. That will enable us to go to the next step and order the property inspection, order the appraisal. Is basically coinciding with step 2 and 3. Essentially happens at the same time. Property inspection is voluntary. I do suggest you do it. The appraisal is mandatory. That is the opinion and value that investors look at to determine the value of the home. Okay. Appraisal might take a couple of days to get ordered, set out of the property, and returned to the investor. After that, they have approval, they have opinion and value, they match it up, and there you go. Number 4 comes instantaneously. The loan approval, based on the value of the home, meets the value of the estimated purchase price. You have the loan approval. Once you have the loan approval, you'll be in communication again with your lender, us. We have a team, you have a processor, and we have a loan officer assistant. They'll reach out to you. Any conditions necessary to therefore go from congratulations, you have an approved loan. Now here are the conditions that it'll take for you to receive the loan docs and get your clear to close. Your clear to close means you receive the loan application, the loan approval, the appraisal matches, there's no issues with the house, nothing is subject to. The loan is cleared to close because you have met the requirements. Some of those requirements can be verifying your employment by verbal call or written verification of employment, proving you have the assets on deposit, either at escrow or in your bank statements that are yours and you source and season them. You met all the requirements for the loan. You received the clear to close. Next step would be to order the loan docs to be signed. You can have them signed anywhere at this point, at your local title and escrow office, our office, or any location you choose for the traveling notary. Once that's done, the information is returned and it's now set to funding. The funding process is when the information goes back to escrow. Escrow's job is to make sure all parties receive their funds. The money's dispersed between title, escrow, the county, property tax assessor, the investor, the wire goes, and their job is to disperse all the funds accordingly. Once they have concurred that all funds have been dispersed accordingly, they then record the subject loan and your deed at the county. And that's electronically now at most counties. You record it as now, congratulations, you're the new owner of that home. After that, then you legally own the home. You're obligated. Therefore, you have your name on the title. You're the legal owner of the home. The keys are allowed to be exchanged from the previous owner to yourself. That's a quick little timeline of how a purchase transaction goes. Sorry for the water break. Okay, mortgage breakdown. I will not go into the full content of this breakdown, but essentially you have 4 elements of every mortgage. In California, you only have to have 2. 2 things are required: principal and interest. Taxes and insurance can either be impounded or non-impounded. So therefore, we want to talk about all 4, but some people only have principal and interest in their monthly payment, and they choose to pay their taxes twice a year, and they choose to pay their insurance one time up front every year. So for the sake of this, it's easier to have your mortgage impounded, where every month you pay your principal, interest, tax, and insurance, all included in one nice lump sum. The trick is, if you pay your property taxes on your own, your monthly payment feels cheaper. But every 6 months, you have a huge bill that's due. And I've seen people get behind or in trouble. So try to keep it simple. Make your payments through an impound account monthly. Okay. So principal is the repayment of the loan amount you borrow. So if you borrow $500,000, it's called an amortization. You borrow $500 at an X% rate. You will pay that down in a scheduled increment of 360 months, 240 months for different years, or 10 years or 15 years, different terms. You pay it down in a sequential amortization. That's what principal is. It's the amount you borrow. Interest, the lender charges interest on the mortgage as a cost of lending you the money. Mortgage rate determines the amount of interest you pay, along with the principal or the loan balance. So it all comes down to interest. That's the reason why the banks lend the property to you. They make their money on the interest. So it's over a term of a 30-year mortgage. at $500,000, by the time you're done paying, you might actually pay $700,000 worth of payments on a $500,000 loan. It's sad to say, but it's the truth. It is interest. That's why it's extremely important to make sure you have the lowest interest rate possible, and you could have your term be accelerated as much as possible by additional payments if you can. By mitigating interest, you mitigate the total cash and cost of ownership over the life of the loan. Property taxes, where we retain a mortgage, and state and local taxes are enforced by mortgage recording tax. You'll see a lot of adjustments. You have the 1% property sales tax plus any adjustments for Melrose, city fees, city bonds, school bonds. All those are attached to your tax roll. Okay. Insurance, have to have in California. Okay. Now, mortgage insurance lowers the risk for lenders of making a loan to you. There's different types of insurance. There's homeowner insurance and there's mortgage insurance. This kind of gives an explanation of mortgage insurance. Now, mortgage insurance is for any loan when you have one loan that's over 80% of the value of the property. Therefore, mortgage insurance is applied. You have standard homeowner insurance that is always going to be your mortgage. Okay. Go to the next slide. Pre-qualification. The pre-qualification, a normal evaluation of your creditworthiness and how much of a home you can afford. This process indicates whether you meet the minimum requirements for a loan and how big the loan may be. Pre-qualification is a great step for those who aren't sure whether they're financially ready for homeownership. Okay, so the difference between being pre-qualified and getting pre-approved. Pre-qualification is when you're kind of exploring. You're giving just a little bit of information, certain piece of information like estimated income. Yeah, I make this much. I have about, $40,000 saved up. I think I have a 700 credit score. So you do pre-qualification based on your anticipated estimated valuations. It's great. You really want to go into the purchase knowing what you're going to qualify for and knowing. That's why you want to get pre-approved. So the next slide, we're going to go into that. Okay, pre-approval is as close as you can get to get confirming your creditworthiness without having to purchase a contract in place. Okay, bottom line, a pre-approval, you are providing the tax returns, bank statements, your pay stubs, your W-2s. You're providing their credit to be authorized to be pulled. So you're getting authorization for a lender like ourselves to pull your credit. You are getting all information, all the steps provided. Copies of pay stubs, 30 days. If you get paid weekly, please, 4 pay stubs you need to bring in. Credit check. It'll be an official credit check. There is soft pulls like Credit Karma and all these other sites that will not cut it. You have to have an official credit report pulled to get a full approval. Most recent tax bank statements. Okay, you need 2 months bank statements, all pages. Do not provide page 1. Your lender will not be happy. You need all pages, okay? Down payment amount and desired mortgage amount. We need to know how much you have to allot for the down payment, how much you have allotted the closing costs. So therefore, we can do the math and determine, do you have sufficient funds and reserves post-closing to meet the requirements of the down payment and the closing costs. Okay, very important. If you are going to be shopping for a home and you're ready to actually submit an offer and go forward, you have to pass the pre-qualification step and get pre-approved. All right, intro to the down payment assistance. This is actually, I like to call it the 4 pillars of homeownership: assets, income, employment, and credit. This is the 4 things that really need to be understood when it goes toward our down payment assistance and our homeownership in general for some home buyers. Next slide. Okay, affordability. There are 4 important factors involved in receiving approval for a mortgage loan. It's like the 4 legs of the stool: income, assets, credit, and employment. Okay. Okay, income. Mortgage lenders want to ensure that they are providing home loans to borrowers who have a low risk of default and have a low possibility of late payments. They want to see the financial stability and a good track record to determine how risky of a borrower you are. One of the most important guidelines for future homeowners is establish ability to repay, ATR. Okay, so a few things we'll go hop down a little bit. Most importantly, you understand there's two main factors in lending: the front end ratio and the back end ratio. The front end ratio, you take your current income, divide by your current debt. Say you make $5,000 a month, your current debt is $1,000. You divide that, and that's how you get your personal ratio. Your back end ratio is that plus more. It's your current income plus your current debt income ratio divided by the target mortgage payment. Okay, you take that same ratio and you add in the future mortgage payment, and that's how you get your front end ratio and back end ratio. It's your current financial situation, and then adding in the potential future of a mortgage to your back end ratio. So you can have a lower front end ratio, but all of a sudden you're getting a very big house, and your back end ratio would shoot up because your potential and future ratios will exceed your existing because you're taking a new mortgage on. These ratios will determine which programs you qualify for, along with other guidelines. Okay, some of our programs have a lower threshold of your back end ratio of what they'll allow you to have for a debt to income ratio. So say 50% of your monthly gross income can go towards your principal, interest, tax, insurance, and your current liabilities. Some are lower, some are higher. Assets. These are the requirements to cover essential costs required in a home. Essentially, your assets are going to come for your down payment and your closing costs. Here are some examples of assets that are allowable: earnest money deposits, checking, savings, CDs, money market accounts, business accounts with valid proof of access to the funds. Okay, some people are self-employed, some people have two jobs. It's very common nowadays. If you have business accounts, you need to show that you have the availability and proof that you can take the money from that account and use it towards your personal purchase. That would come from either your corporate tax returns, your K-1s, showing your ownership, or a letter of explanation written from any of the partners you have saying you have the ability to access those funds for the use of the purchase of the said home. Stocks, if you have stocks, that's great. If you're going to use it for the purchase or down payment, closing costs, you can show your statement, show the amount of funds you have that are in equities, but when it comes time to purchase, they need to be liquidated. Okay, there are some accounts we can put a hold on those, but that's a little more advanced. And for the traditional purchase, you're going to use stocks and you use bonds, you have to liquidate those to be used towards the purchase of your home. Okay, IRA and 401ks, you can use those for reserves. You can use for down payments also. If you have the IRA account and you have liquidated funds from, say, stock or bonds or savings, but there's a post-close reserve requirement, you can use your retirement, show that to your lender, say, I have the availability to show that I have funds that exceed 2 to 4 to 6 months of reserves based on my 401k statement. Now, the last is gift funds and gift of equity. This is very important when it comes to the down payment assistance programs for first home buyers. You are allowed to receive funds from family or gift funds from certain programs that can cover up to 100% of the required down payment. So if you can show you can afford the actual mortgage, but you don't have the money yourself for the down payment, you can get gift funds, okay? Very simple. Next slide. Credit, pretty simple. Credit important in qualifying it for a home mortgage. Credit ratings show how risky a borrower you are. Borrowers with a high credit score tend to have lower interest rates on mortgages than borrowers with low scores. Simply put, you're less risky. We provide home mortgage down to 500 credit score. The higher credit, the better. Low is okay. Below, from 500 to 580, you will be required to bring at least 10% down. Once you cross over 580 credit score, we have programs through the Federal Housing Administration at 3.5%. Okay. Now, most conventional, all conventional, either Fannie and Freddie Mac, their minimum FICO score is 620. So it's a very important number. 620 is going to be the number that allows us to get into conventional homes and our best DPA program. Next slide. Okay. Employment, pretty self-explanatory. Rule of thumb is 2-year rule. That's it, 2 years. Lenders want to make sure that you can show these 2 years of, it's called continuity of income. They want to make sure that you've been employed in the same line of work for at least 2 years. If you have not been in the same line of work for at least 2 years, but you've been employed for 2 years, that requires extra information, kind of showing that you haven't had a break in employment for more than 6 months. You know, if it's more than 6 months, you have some explaining. They want to show you that you have continuity of being employed, preferably in the same line of work for at least 2 years. If you've been working for 4 years and you've been in the new industry for 1.5 years, letter explanation can clear it up. So there's always a little bit of variation, okay? Debt to income ratio. You gotta know your budget. It's important to know the maximum loan amount you can afford. Lenders figure out by looking at your debt to income ratio, DTI, percentage of your income that's spent each month to pay your debts and among other things, okay? So we covered this a little earlier, debt to income ratio. You need to look at your total monthly income and your total debt obligation. You take those numbers and divide it. You can see how much of the debt to total income ratio you're utilizing. That's how you figure out your front end ratio and your back end ratio. Tips to improve your credit score. Pay down credit balances. Don't close old accounts. So that's very touchy. As credit's changing, there's another change that's coming in 2023. You have a lot of different kind of opinions on old accounts, keep them open, keep them shut. Please refer to Experian TransUnion directly for their opinion, but based on our information, closing old accounts will not benefit you in most situations. It would actually hurt your credit score. If it's not affecting you negatively now, kind of leave it alone. You want to make changes that are only going to benefit you. Ask for late payment forgiveness. If you have a late payment, try as hard as you can to have your creditors remove that late payment from your credit report. It makes a big difference having no 30-day late, 60 or 90s, okay? Review for any errors on your credit report. Check it out. Once you pull the credit report, we'll review closely. You'll know your credit better than we do for errors. Like, I actually have never had that credit card before. We won't know that. We'll just know it's there. So you need to look through it yourself with us to make sure that all the liabilities associated with the credit report are true and are verified as yours. Pay off delinquent balances. So if you have an account that's delinquent, you need to bring it up. If you have account in dispute, you have to clear it out of dispute. When you have an account dispute, it's like a miniature lawsuit, and it will not allow us to receive a pre-approval. You're telling the lender that, hold on, I have a disagreement with a set account with, let's just pick a lender, Discover, right? I have a disagreement with Discover regarding this charge, and I'm disputing it legally. And until that dispute is resolved, there's no pass go. So you need to make sure any disputes have been closed and resolved. Therefore, we can get a full approval. Okay, here's a fun little diagram of mortgage down payment systems comparison. Conventional loans, 20%, 5%, private mortgage insurance. The difference is conventional, you have different options. At 20%, you have no mortgage insurance, because once you have one loan that's 80% or less, so once you cross 80% or more, you have mortgage insurance. So therefore, if you have 20% down, or you have a 80% first, 10% second, 10% down, you have no mortgage insurance. If you have 5% down, it's a substantial savings in your down payment requirement, but yes, you're gonna have private mortgage insurance. FHA, it's highlighted for a reason. We'll come back to it later. But 3.5% down. So FHA allows you to do 96.5% as a loan amount with 3.5% down. Mortgage insurance is yes. It will always be yes. The Federal Housing Administration through the HUD has made mortgage insurance through FHA a requirement for the life of the loan. So that's very important. Life of loan, regardless of how much equity you build, you'll have mortgage insurance. At some point, it behooves you to refinance out of the FHA loan into a conventional loan that can have no mortgage insurance. That'll be a savings to you and your family with life of loan. If you're a veteran, thank you so much for your service. Our VA loan is 0% down. It's amazing. It's 100% down. With your DDG 14, 180 days good service, you qualify for 100% financing. There's no mortgage insurance. And the guarantee fee is yes. So the VA has it's called an upfront mortgage insurance premium. They finance it in, or you can pay it at closing. They allow you to pay a mortgage insurance premium. They finance that portion into the VA home loan. It's typically 3.3, 3.2. Okay. USDA, it kind of mimics the VA, where you have 100% financing available, but you have mortgage insurance requirement. So that's a little caveat. The USDA is the United States Department of Agriculture. So therefore, you cannot get a USDA loan in the middle of San Francisco, right? It has to be zoned agricultural. So therefore, you go to the USDA website, you do a lookup for eligibility, you type in the exact property address which you're looking at buying, and it'll let you know if they qualify for a USDA loan, depending on where it is on the kind of the geo plat map. Okay, just little icons of government-backed loan programs for first-time home buyers. VA, FHA, and USDA. These are 3 programs that are government-backed sponsorships for first-time home buyers. Traditional and portfolio loan programs for first-time home buyers. Conventional mortgages, the more secure loan program. Lock in a low payment and sleep tight knowing that your rate will not change. Now, under conventional, there is fixed and there's ARM. So if you're getting a conventional mortgage that is a 30-year fixed, this holds true. But there is conventional loans that have a 10-year fixed and then it goes 20 years adjustable. They have 7-year fixes and 5-year fixes. So conventional loans do come in ARMs, adjustable rate mortgages. They have a fixed period loan for a certain portion of time. Then it goes adjustable, either on an annualized basis or every 6 months it has an adjustment. Portfolio non-QM. So non-QM stands for non-qualified mortgage. That's any mortgage that cannot be sold to Fannie Mae and Freddie Mac as a traditional mortgage. Those are more private portfolio mortgages that are sold non-government sponsored enterprises to the private market. Okay, we have our no-doc home loan that fills in the void. We have bank saving programs that are for self-employed borrowers. If you're self-employed, you have a hard time qualifying using your using your pay stubs and using your tax returns due to the legal requirements you're allowed to do for deductions and expenses and write-offs. This is an awesome program. It allows you to qualify using your deposits, essentially your bank statements. And we can go into that a little later. But for our portfolio non-QM is an awesome tool for home ownership for our self-employed professionals. Okay, the VA home loan. Talked a little early on icons. If you're active duty, you've served 90 days continuously. If you're non-active, it's 180 days of wartime service, right? It basically, I'll try to speed up. VA home loans are not available for everybody. You have to be serving or have served in a United States Armed Services to receive the benefits. No down payment, no private mortgage insurance, competitive rates, literally the best rates. Closing costs, limits, lifetime benefit, no prepaid penalties, and foreclosure avoidance. It's awesome to get a VA loan, you've earned it. Okay, advantages of a FHA home loan. So FHA, Federal Housing Administration, low down payments. FHA loans are popular among buyers wanting the low down payment. It's 3.5%. Lower interest rates. The Federal Housing Administration does have lower interest rates for FHA as opposed to conventional, but they have a higher monthly mortgage insurance typically. So you have an MI on your monthly mortgage insurance as opposed to your PMI, your private mortgage insurance. So you do have a little bit lower traditionally of an interest rate, but sometimes it's offset by having a higher MI factor. The MI factor for FHA is 0.86. So it's 0.860. Okay. Credit requirements. FHA loans do not require perfect credit. You can have a 550 and get a home loan. You want to see 580. 580 will give you the ability to do 3.5% down. That is the benefit for FHA. Also, FHA will allow you to get into your home faster. On a conventional mortgage, you have about, for bankruptcies, short sales, foreclosures, you have 4 to 7 years that you have to wait to reobtain a home. With FHA, with bankruptcies, depending on what type you do, 7 or 11, or a foreclosure, you can reobtain ownership in 1 year with different types of bankruptcies and 3 years with a foreclosure. So it will dramatically accelerate your ability to retain a home for your family. Use the FHA mortgage. Closing costs, they allow for sellers to pay up to 6% of the loan amount. That's covered by the buyer, pay up to 6% of the loan amount to cover buyer's closing costs. The seller can only pay 3% on conventional loans, right? So you're able to double this. Now, this fact will come in really handy when we get a little deeper into our DPA conversation in a few slides. USDA, we kind of covered that. We're past the 130 mark, so I want to kind of go past the USDA. Conventional, we covered conventional. The minimum FICO score conventional 620. Typically, you see debt income ratios at 49%. That means 49% of your total gross monthly income. Down payment assistance, affordable home programs. We'll hop right into this. Some of the definition: a first-time home buyer is a borrower on the loan application that meets the following criteria: is purchasing the subject property, will reside in the subject property as their principal residence. Very important. First-time home buyers for these programs require owner occupancy. You cannot buy or utilize these programs as an investor. You need to have it for your primary residence. You've not had an ownership of the property the last 3 years, or is it? So this is also kind of ties into our DPA program. Okay, so for the sake of time, we will end it here. The next few slides are DPA programs to give time for people to have comments and questions. This is our exclusive Badge Broker down payment assistance program. This is an amazing investor that was brought onto our company to resolve and solve a problem. You will receive our DPA program that forgives 3.5% grant funds every 6 months and allows you to qualify without any income limits. This is a very, very huge thing. So under FHA, you are allowed to have a 96.5% loan amount. 3.5% is a down payment requirement. We have an amazing program. It will give you, with grant funds, 100% of the down payment. That is 3.5%. 6 months later, after 6 months of payments, so typically in a purchase, you have 1 month without a payment, and then you have 6 months of payments. You will have this mortgage be forgiven. Any borrower on a loan application that is currently retired, volunteer, non-paid employee can qualify. See below. If you're a first responder, police officer, firefighter, public safety officer, paramedic, emergency medical technician, or similar. Educator, simply from the principal to the janitor. If you work for a school district or an educator, you qualify. Medical, it's no longer just doctors. You can be a doctor to a janitor working at a facility, healthcare, and daycare. You qualify. Civil servant in federal, state, and local municipality, very important, right? So if you're working at an Air Force base, a military base, a naval base, and you are not enlisted, but you're serving our country, working on base or as a civil servant, you now qualify. You don't have to actually have served yourself, but you can be a civil servant that's working in behalf of a federal, state, or local municipality, and you qualify. Military personnel, you qualify. You get the VA opportunity also. Sometimes some veterans have had a previous foreclosure on their VA benefits that enables them to utilize their VA to 100% of the value again. These military personnel come over to our program and now have 100% availability to buy a home. Okay, it's really important. Okay, affordable mortgage program. So this is a whole term program. I would like to stop here and see if you have any questions regarding our DPA program or information covered so far.
I don't see anything in the chat yet, but if you have any questions, you can either unmute yourself or type something in the chat now. I don't see anything. Greg, you can go ahead and continue.
Okay, so if no one has any questions, for the sake of time, it's 1:41. I would like to offer everybody the opportunity to, we'll send the slides out after this is over, and have a little highlight of the program. In closing, really, the DPA program is something that's awesome. It allows you to buy a home in California if you qualify under the certain variables, which you're buying in a certain census tract. If you're buying in an area in the state of California that has a census tract where over 31% of the occupants of that census tract are from one minority class, you qualify. If you're a first home buyer, you haven't owned a home in 3 years, you qualify. If you're any one of those service providers, first responder, public servant, civil servant, doctor, teacher, nurse, healthcare, you qualify. If you have owned a home and you recently had received a divorce, you no longer own that home, you can now requalify as long as you show that the last property owned was with the subject that has the divorce decree. You can reapply without waiting 3 years to utilize this amazing program. So hopefully these answer your questions. We'd love to talk to you about taking the homeownership step further. And if nothing else is questions in the queue, I look forward to talking to you guys soon, and we're here to serve you. Bye-bye.